What is that you're drinking there?
It's water.
Where did it come from?
Came out of the tap.
How did it get into the tap?
What do you mean, how did it get into the tap? It came through a pipe.
How did it get into the pipe?
I suppose it rained somewhere, upriver. I don't know, in the Alps. It came down the river. It came out of the river into a pipe. Came out of the pipe. Now it's going into my mouth. It's the water cycle. I've seen my daughter draws it when she's, doing science projects and things like that. Rain, down the river, into me, eventually out of me.
But you're missing a piece there in that cycle.
What am I missing?
Structured finance.
Oh, well, obviously. Where's the structured finance in that?
Well, depending on where the pipes are, these pipes may well have been financed by structured finance. In Italy, in certain parts of Italy, these might be financed by something called the hydrobond.
Oh, everything tastes better in Italy, doesn't it? Even the water has an extra bit of structured finance in it. Subscribe to this podcast on iTunes and on Spotify, yes, Stitcher,
and YouTube.
You can go on YouTube and see us. That's right. Or well, hear us anyway. You'll be seeing us soon. Does that get you interested? And then if you subscribe, you'll be able to get all these episodes, not just the hydrobond one, but all the older ones and the ones that are coming up, like next week when we have one on the European Fund for Strategic Investments, which I particularly enjoy saying, which is part of the investment plan for Europe, and you don't want to miss that. So hydrobonds, we're joined by Thomas van Gilst. I'm saying that with my best Dutch there. Did I get it right?
Excellent.
Very good. He's head of water security and resilience. We should really have a Dutchman in charge of water things, shouldn't we? Because, you're very tall. Is that so that you can be above the level of the water even when you're standing on the ground? And actually we met in the swimming pool.
Yes, that's correct. Yeah.
That's right. Which is that your thing? You like to swim, particularly?
Yeah. Well, I find it quite boring, but it's more for the exercise that I like to do it. But it's not to say that I don't enjoy being in the water. It's just doing laps that I find a bit boring.
I can relate to that. Yeah. And we're also joined by Patricia Castellarnau, who is a senior economist in the Water Security and Resilience Division here at the European Investment Bank. Are you a swimmer? How do you get your exercise?
I'm more a yoga person than a swimmer, actually.
So it's more kind of balanced.
Yeah, still exercising, but more on the ground.
Okay.
And the water.
So, our listeners can't see this, but actually Patricia is standing on her head to do the whole of this podcast.
Exactly.
So let's start by talking about the hydrobond. What is it, Thomas?
Well, actually, it's how would you say? It's actually a bond, but it just has the name hydrobond simply because the underlying issuers of the securities are water companies. So it's giving it a sexy name for something which is actually quite plain. I mean, it's just a bond that's there are securities that have been issued, purchased by an SPV, and then on-sold to the EIB.
An SPV, a special purpose vehicle. There's something special about it, though. If it's a special purpose vehicle, we've issued bonds before, the bank, on behalf of water companies, but they were just bonds. What's different about this one, let's say?
This one is actually a packaging of many small, notes by smaller companies, which are basically too small to have any appeal for, institutional bond buyers, like, for example, pension funds, who would be the typical buyers of EIB bonds. And they need not only a certain size, but also a certain credit rating. And each one of these small utilities alone does not have neither the size nor the credit rating to be able to appeal to such a market. The idea basically was to package them together and make a single product, which then the EIB together with some other institutional investors would then buy. So by buying that, we're paying them money, which they then use to invest in their investment programs too.
So if they weren't able to do it with a bond like this, where would they get the money, these small water companies?
When they first approached us, they had a lot of difficulties. It was shortly after the financial crisis, and banks were not happy to lend to these small utilities for a long period of time. So they were giving loans of 4 or 5 years, which is completely out of sync with, let's say, the longevity of the underlying assets. So if you then have to pay back a loan in a very short amount of time, and imagine getting a mortgage for your house and having to pay it off in 4 years, it's just simply impossible, unless the tariffs, go through the roof, which would lead to social issues, obviously. So they really had issues financing their investment programs, and which traditionally they were doing with commercial banks.
But for the investors, what are they looking for in that hydrobond? Is it that there are specific investors who are interested in investing in water companies, or are they much more likely just to be interested in a utility company? So maybe if we called it a utility bond, it would attract more investors, or is there a class of investors who are looking specifically to invest in water?
I think that in this case, the idea was not to create a new market like we might be doing with or climate awareness bonds. The issue here was more to be able to lend to these utilities that were having difficulties, and in the process to draw in some local institutional investors. So to make them, let's say, see that this is a sector which is going in the right direction, for a lot of reasons that we can talk about later if you like, but that and trying to open up their eyes into for this sort of sector.
To add on this point, the Italian water sector was really at the moment a critical point where the regulatory framework had changed, and it was giving investors more security as to putting money into the sector, into water utilities, with a rather stable returns. So I would say this was a combination of having a sector that was going, as you said, in the right direction, and at the same time the bank was trying to support this movement with more targeted and tailored products such as the hydrobond.
Roughly how many, Patricia, was the number of the different water companies that were involved in this?
So initially in the first phase, there was 9 operators in the region, in the Veneto region. And so these operators are a group and an association, which is actually the promoter, the main counterpart of the bank in this operation. And then, because it was successful, they attracted another 4 utilities from the region. So that's why then the investment, the investment program that is supported with these bonds has increased. Now it's over 500 million euros of capital expenditure that will be financed through these bonds. Mm-hmm. Initially, it was less than 300 million.
So that's half a billion essentially of euros that, because all these different investments were pooled together, they were able to essentially raise and spend that money, whereas before they wouldn't have been able to.
Exactly. And probably it was, if they didn't have access to this type of product, probably the investment program would have taken much longer to be implemented, because as Thomas mentioned, if you don't have the right financing, then you have to, it's too expensive, and you have to reflect that in your tariff, and the water price becomes too expensive. So you would have to phase your investment program to make sure that the water doesn't suddenly become too expensive to the people in the region. So
I guess the reason you could do that, though, is because these companies are not competitors, right? They're not competing against each other. Everyone is serving a different region. Or do you think this model could work for other types of companies in the water sector or beyond, that you could combine similar notes?
Actually, it's a very good point. Indeed, they're natural monopolies, so they don't compete against each other during their concession period. No. At the moment, they're all fully public, so they wouldn't venture outside their service area, in terms of trying to get concessions elsewhere.
They could get money from the banks that they had to pay back much sooner than the actual pipes or whatever other material infrastructure they were laying would need to be replaced, etc.
Yes. Yeah.
So that they wanted a loan that would last as long as the pipes, more or less.
Ideally, yes. Having said that, actually, the pipes is one of the components in the investment programs which have the longest life.
Yeah.
Mm-hmm.
They go like from 50, they can go up to 100 years easily.
Mm-hmm.
So they'll never get a loan with that tenor. But let's say the average, there are parts like electromechanical components in the wastewater treatment facilities, for example, which may need to be replaced after 12 and a half years. So we tend to look at the average of the life. And well, usually we're just about a bit less than it, but still we're one of the lenders that provide the loans with the longest tenors. So that's I think the competitive edge that the EIB has over many other institutions.
I think that longevity of the assets is one of the things that makes it difficult to understand why these companies need to be doing that much investing, because to me, water utility companies, it seems like the pipes are in the ground. They're working. Why do these companies need to invest so much in the first place?
Yeah.
What do they need to do?
It's simply because the asset base, let's say the value of all those pipes is so high, you couldn't replace it financially in one go, because it may be in a small service area with, let's say, a few 100,000 people. Maybe they have 500 millions worth of even more, maybe $1 billion of assets that you can't replace overnight, and then also the physical time that it takes to replace them, and the disturbances that you would cause. If you turned all the roads upside down for however long it took to do it, then for that year it would be crazy. So it has to be done a small bit at a time.
You mentioned that it's something that was put together for this specific group of 9, then 13 Italian water companies. So that makes it a very good example of structured finance, which our listeners will have been hearing about in last week's podcast. It's a very good example of that. Having said that, is it something which you could look at in let's say other areas of Italy, other areas of Europe, or even outside Europe where you are doing a lot of your work, to recreate?
You could look into this structure, but I would say that you need a very important condition. You need to have essentially a public counterpart, whether it's a financing institution from a region, or that is really pushing this product. You need the utility. They all operate in the concession in their area, and they're all looking at the little region or province. So you need to have something higher from a regional level to really incentivize them to come together, incentivize them as well in financial terms, which means you need to have, for instance, the region saying, okay, to help you come together and, issue this bond together, I'm also ready to reduce the risk that you're taking, let's say, by putting some money, some public funds to lower the global risk of these operations. So you need to have that. They've tried in other regions in Italy to start this process, and maybe this is missing. So they're not coming to terms, and they're not able to, to finalize the whole process. So, but I would say that otherwise it can be replicated in other regions. In other countries, it depends on the legal framework, because Italy has a special legal framework for these mini bonds and for this what they call securitization, which makes the product work in Italy. In other countries, that would be different.
Maybe I can just add, indeed, with Viveracqua, there were two things. One was Patricia mentioned the support by the region. In this case, I think it was 6% of the investment amount, which they set aside as a guarantee. And then the individual utilities set aside another, I think it was 14% of the investment money, of the investment amount, as a guarantee. So basically, as the investments took place and the repayments started gradually taking place, they could also eat into that guarantee. They could use the guarantee money basically again. So it wasn't like giving it away. It's just like putting it there in a safe, a cash reserve in a safe in case any of them defaulted. Mm-hmm. So this was just 6% from the region. It's a very small amount and a huge leverage effect if you look at it from that perspective. Another condition was that Viveracqua, which is basically the SPV already existed because they had already teamed up to have better bargaining power with energy companies to reduce the energy bills, because water supply water is very heavy, so pumping it around costs a lot of electricity and therefore a lot of money. So it was in their interest to reduce this, and they had already this structure through which they worked together, and I think that was also a very important condition for the speed with which this operation took off.
But what are the incentives for them to be investing in the first place? You mentioned earlier how the pipes are underground. You don't really see what condition they're in. Is it that there are requirements for the quality of water? Is it that they're looking out for the sustainability of their business model over the 100-year period? What's really driving them? Are they trying to minimize the leaks? What's driving them economically to take on these investments in the first place?
Well, you have two aspects to this question. Essentially, you have first the legislation, so you have European directives with which they have to comply, and these European directives are reflected in national legislation. So basically, there's a compulsory or legal requirements that they have to meet, and that's why they are investing.
And these legal requirements, they deal with the quality of water, or what do they deal with?
Exactly, they deal with the quality of water. They deal with the way you collect and you treat the wastewater in order to avoid pollution of the environment, essentially. So this is the very general framework. And then you have obviously efficiency gains. So these companies have understood that they will gain, they will profit from investing in, for instance, reducing the leaks, as Thomas mentioned. You have very high levels, 30-35% of water that is lost in the process. This water before has been pumped, has been treated. So if you manage to reduce the level of the leakage, obviously you will improve the profitability of your company. So these utilities have incentives to do that.
And the regulations, are they getting tighter as well, or?
Always, yeah. I mean, now the latest things are micropollutants, which are becoming an issue, and the next wave of regulation will address that, making basically the treatment more expensive as well.
I want to get to
processes.
Sorry, I want to get to a term, as we're a dictionary of finance and we're about defining terms. I want to get to a term that people might at first not know, but also might not associate with economics and finance, and that is, Thomas, water security. What is water security, and what's the economic factor in that?
Well, water security is not a financial term. It's obviously very much a physical term, the way that we intend it. Basically, it's about security of supply, mainly of supply, and also of the whole service, so also getting rid of the wastewater once you've used it. We also mean flood protection, so protection from too much water, and obviously too little, but that too little is more from a water and sanitation perspective. Too much of it is more from a flood protection perspective. But the economic importance of it is, well, from flood protection perspective, it's quite obvious, because obviously if you wash away a whole village with its industrial facilities, then if that all floods, then basically everything comes to a standstill, and there's a huge impact, which is quite obvious, besides lives as well, which also have an economic value. And then from a water and sanitation perspective, I mean, it's quite clear that even there, I mean, industries need water, people need water, even just to be in the office. You need to have access to some potable water. You need bathrooms, there's some very nice pie charts which show for different industries how long they would survive without water. And I think like 90% of the economy comes to a standstill if they don't have access to water and wastewater within a matter of a couple of days.
I'd be going home in half an hour without water. What do you mean? I get dehydrated very quickly. Yeah, exactly. Well, there's a statistic that I saw that said that 8 out of 10 jobs are dependent on water security. Now, that doesn't mean that 8 out of 10 people are just going to dry up and fall over because they don't have water to drink. It means that, as you're saying, that in some way the business is dependent on water, and that applies in the EU as well. It's of course, and not just in countries in Africa, which we normally think of as being affected by drought and people dying because of that.
That's correct. I mean, there's a lot of, even just the paper that we have here on the table, for example, is produced with a lot of water in the process of making it. So it doesn't take much to realize that water everything has a almost everything has a water footprint. So you take away the water, then they can't, if they can't have their footprint, then they can't exist, basically. It's maybe not very well put, but yeah, it's as simple as that. Yeah.
And how scarce is that resource now?
I think the amount of water in the end is that falls from the sky on an annual basis hasn't necessarily changed that much everywhere. Of course, there are areas which have less of it, but on the whole, if you look at a very vast geographical area like the EU, I'm not even sure whether there's been a specific decline or an increase, but it's more the variability of it which puts us into problems. So not having long droughts in the summer, just when the crops need the water the most. That's where you really suffer the consequences of climate change and all that. So the scarcity is for very short periods of time that really causes the issues. But it's, in many cases, it's not that there's systematically less water falling over longer periods of time. It's more the variability.
Yeah, we're talking about these hydrobonds in Italy, and Italy was affected by very severe water scarcity last year and continues to suffer from that. And going back to what was mentioned before, the economic losses of where there is water flooding of water scarcity, they are absolutely huge, because you need to compensate for the lack of water. So you need to transport, or you need to replace that water. It needs to come in the end. So it's Italy in this particular case is now an example.
Thomas, Patricia, thank you so much for explaining all this stuff, and it was a very flowing discussion. No more water puns. We'll just say...
We didn't freeze.
Oh, very good. We didn't even get into that. So this was a Dictionary of Finance from the European Investment Bank. We would love it if you would subscribe, but actually we think you would love it if you subscribe. So you should subscribe to this on iTunes, on Stitcher, on Spotify, wherever you listen to things. And then you can also get in touch with us to talk about how great it is, but also to ask us questions. Either about this episode, which we could then put to Patricia and Thomas offline, as it were. I'm at EIBMatt, EIBMatt.
And I'm at Allartankler, ALLARTANKLER.
And he's managed to spell his name again. It took a moment. There you go. Very good.
Thank you. And tune in again next week for another episode of A Dictionary of Finance.